A company once praised as the future of European finance collapsed almost overnight, wiping out billions in shareholder value and shaking confidence in financial oversight across the continent. It had been listed on Germany's top stock index. Major banks worked with it. Global investors bought its shares. According to reports, it presented itself as a fast-growing technology leader in digital payments. Years later, investigators would say much of that success was built on false financial information. The company was Wirecard, founded in Germany and operating in the fast-expanding world of electronic payments. In the early 2000s, digital transactions were becoming more common, and investors were looking for companies that could process online payments securely and at scale. Wirecard said it provided exactly that. It handled card payments for merchants, offered financial services, and positioned itself as a European answer to major global payment processors. Growth figures appeared impressive. Revenue and profits were reported to be rising year after year. According to company statements at the time, Wirecard expanded into Asia, the Middle East, and other regions. It described partnerships with third-party companies that were said to generate large volumes of payment business. These claims supported a narrative of rapid international expansion. Financial markets responded. Wirecard's share price climbed significantly over the years. In 2018, it reached a symbolic milestone by joining Germany's DAX index, replacing a traditional bank. That move signaled to many investors that the company had become a pillar of the country's corporate landscape. Being part of the index also meant pension funds and institutional investors increased their exposure. The story seemed to fit the moment. Europe wanted technology champions. Fintech companies were seen as innovative and scalable. According to market analysts at the time, Wirecard's business model combined payments, data, and financial services in a way that looked modern and competitive. Its reported margins were higher than many traditional payment processors, which added to the appeal. However, even during this rise, questions surfaced. As early as the late 2000s, journalists and short sellers raised concerns about accounting practices and business relationships. According to reports, critics questioned how much of Wirecard's reported profit came from operations managed by third-party partners rather than directly controlled subsidiaries. These partners were often located in distant jurisdictions, making independent verification difficult. The company strongly denied wrongdoing. It said allegations were false and damaging. Legal action was taken against some critics. Public statements emphasized compliance and audits. Wirecard's accounts were signed off by a major international auditing firm for many years. This audit approval reassured many investors that the financial statements were reliable. Behind the scenes, regulators were also involved, but the picture was complex. Germany's financial regulator oversaw certain parts of the company's banking operations, while other business lines fell under different rules. According to later reviews, this division of oversight created gaps in supervision. At the time, these structural issues were not widely understood by the public. Meanwhile, Wirecard continued to announce strong results. According to its published reports, large portions of revenue were generated through so-called third-party acquiring partners, particularly in Asia. These arrangements were presented as a way to access markets where the company did not hold its own licenses. Cash balances linked to these operations were said to be held in trustee accounts at banks. For ordinary investors, the numbers told a simple story. Sales were growing, profits were stable. The company was expanding globally. Media coverage often described it as a German tech success story. Trust built gradually, supported by index inclusion, analyst coverage, and audited financial statements. But underneath that trust, doubts never fully disappeared. Investigative journalists continued publishing articles questioning specific transactions and accounting entries. According to those reports, some customers and partners listed in company documents were difficult to verify each time. The company rejected the claims and said it was the target of market manipulation. The tension between public confidence and persistent allegations set the stage for what followed. A fast-growing technology company, celebrated by markets, faced repeated questions about transparency. Most investors chose to believe the official numbers. Regulators did not publicly declare major concerns. The share price remained high. The rise of Wirecard showed how quickly trust can form around a compelling growth story, especially in a sector linked to innovation and digital finance. That trust would later face a test few expected, one that would turn reported profits into a central piece of a criminal investigation. As Wirecard's reported growth continued, a key part of its business model drew increasing attention, so-called third-party acquiring, often referred to as TPA, according to company disclosures. In markets where Wirecard did not have its own licenses, external partners processed payments on its behalf. Revenue and profits from these partners were then recorded in Wirecard's accounts. These third-party relationships were important. According to company reports, a significant portion of group earnings came from just a small number of such partners, mainly in Asia and the Middle East. Cash connected to these operations was said to be held in escrow or trustee accounts at banks. These balances appeared on Wirecard's balance sheet and supported the company's financial strength. Journalists and analysts began asking how these figures were verified. According to investigative reporting over several years, some of the partner companies were small or hard to trace. Critics questioned whether they generated the large volumes of business reflected in Wirecard's accounts. The company maintained that the operations were legitimate and commercially sensitive. In 2015 and again in later years, media investigations published internal documents and whistleblower claims. These reports alleged that revenues might have been inflated and that some transactions lacked economic substance. Wirecard rejected the allegations and said it was the victim of a coordinated attempt to drive down its share price. According to reports, German authorities at one point investigated journalists and short sellers rather than the company. Audits remained a central point. For years, Wirecard's financial statements were signed off by Ernst & Young, commonly known as A. The presence of a major auditor reassured investors. According to later official reviews, the audit process relied in part on confirmations from trustees and banks regarding the existence of cash balances. However, questions intensified in 2019. A series of investigative articles published detailed allegations about accounting practices in parts of Wirecard's Asian operations. The company announced a special audit by another firm to address the concerns. That review reported difficulties in obtaining certain data, but did not conclude that the business as a whole was fraudulent. At the same time, Germany's financial regulator BaFin faced criticism. According to later parliamentary inquiries, BaFin had limited authority over Wirecard's non-banking operations and did not conduct a full forensic investigation at that stage. The regulatory structure, which separated oversight of banking and technology activities, later became a focus of reform discussions. Inside the company, pressure grew. According to prosecutors, internal compliance staff and some managers raised concerns over time about accounting and documentation. The details of these warnings became clearer only after the collapse. When court documents and testimony were made public, the turning point came in 2020 during the annual audit process. U.S. sought direct confirmation from banks about the existence of around 1.9 billion euros in cash, reportedly held in trustee accounts. According to the company's later statements, documents provided earlier had appeared to confirm these balances, but when auditors contacted the banks directly, the institutions said the documents were not authentic. This discovery was critical. According to Wirecard, the funds likely did not exist. The company delayed publication of its financial statements, then announced that a large portion of the reported cash was missing. Within days, the long-standing narrative of stable profits and strong liquidity unraveled. Share prices fell sharply. Trading in the stock was temporarily halted. Investors who had relied on years of reported results faced sudden and massive losses. What had been framed as a technology growth story shifted into a liquidity crisis and potential accounting fraud. Shortly afterward, Wirecard said its prior financial statements might not be reliable. According to company disclosures, loans became due and lenders reconsidered their positions. The business model that depended on trust and reported numbers could not function. Once those numbers were in doubt, authorities moved quickly. German prosecutors opened investigations into suspected fraud, market manipulation, and false accounting. Offices were searched and senior executives were questioned. According to reports, internal documents and electronic records were seized as part of the inquiry. The warning signs that had appeared over more than a decade, questions from journalists, complex third-party structures, and reliance on distant partners now look different in light of the missing cash. What had once been explained as innovation and global reach became central to investigators' efforts to understand how reported profits had been generated. The mechanism of growth, built around partnerships and trustee accounts, was under scrutiny. The system that supported investor confidence was collapsing. What remained was the question of how such a large discrepancy could have persisted for years in a company at the heart of Europe's financial markets. Within days of admitting that 1.9 billion euros in reported cash likely did not exist, Wirecard's crisis turned into insolvency. In June 2020, the company filed for insolvency in Germany. It was one of the first members of the country's leading stock index to collapse in this way. According to reports, billions of euros in market value were wiped out, affecting institutional investors, pension funds, and individual shareholders. German prosecutors moved to criminal investigations almost immediately. Authorities focused on suspected fraud, false accounting, and market manipulation, according to court documents. Investigators examined whether revenues and profits had been overstated for years, and whether investors had been misled through financial statements and public communications. Attention quickly turned to senior leadership. Markus Braun, the company's former chief executive, was arrested in 2020. Prosecutors accused him of being involved in a long-running scheme to inflate revenues and assets. Braun has denied the charges. Court proceedings in Munich later began to examine evidence related to accounting practices, internal controls, and communications with investors. Another central figure was Jan Marsalek, Wirecard's former chief operating officer. According to investigators, Marsalek was responsible for large parts of the business tied to third-party partners. After the collapse, authorities said he left Germany and did not appear before investigators. Interpol issued a notice seeking his arrest. His whereabouts became a subject of international interest, though official statements emphasized the financial investigation. Auditing practices also came under scrutiny. Which had signed off on Wirecard's accounts for years, faced investigations and legal claims. According to official reviews and media reports, auditors relied on documents and confirmations that later proved to be false. Questions were raised about how such a large discrepancy could go undetected during routine audits. Regulatory bodies in Germany and elsewhere reviewed audit standards and oversight as a result. Germany's regulatory system faced criticism as well. Parliamentary inquiries examined the role of BaFin and other agencies. According to inquiry findings, gaps in supervision and a focus on market abuse rather than accounting concerns contributed to delayed action. Reforms were later introduced to strengthen financial oversight and auditing enforcement. The impact spread beyond Germany. Banks and investors across Europe reassessed their exposure to fast-growing financial technology firms. Confidence in reported figures from complex international operations was shaken. According to analysts, the case became a reference point in discussions about corporate governance, internal controls, and the risks of relying on third-party partners in distant jurisdictions. Legal proceedings have been lengthy. Court documents showed prosecutors presenting evidence about internal communications, accounting entries, and the structure of trustee accounts. Defense teams challenged these interpretations. The case has involved thousands of pages of records and testimony from former employees, auditors, and experts. For investors, the consequences were immediate and personal. Shares that once traded at high levels became nearly worthless, according to reports. Some shareholders filed lawsuits seeking damages from the company, its former executives, and auditors. The financial loss was not just a corporate event, but a blow to public trust in market safeguards. The Wirecard case is often described as one of Europe's largest accounting scandals. According to investigators, the alleged fraud involved overstated revenues and fictitious cash balances over a long period. It showed how a company operating in a modern, technology-driven sector could still rely on traditional forms of financial misrepresentation. The collapse also changed regulatory discussions across the European Union. Policymakers debated how to supervise cross-border payment firms and how to ensure that audit evidence is independently verified. The case highlighted how global financial flows, digital services, and complex corporate structures can challenge traditional oversight years after the insolvency. Finally, court cases and regulatory reviews continue. The full legal outcome will depend on judicial decisions based on evidence and due process. What is already clear from reports and investigations is the scale of the failure. Investors trusted published accounts, regulators trusted audit processes, and markets trusted the image of a successful technology company. When those layers of trust broke at once, the damage spread quickly. The story of Wirecard is not only about missing money, it is about how confidence is built in financial markets and how difficult it can be to detect problems when growth narratives, complex structures, and professional assurances align. For viewers following financial history, this case stands as a reminder that transparency and verification are essential, especially in fast-moving sectors. If you want more fact-based investigations into major financial events, consider following the channel for future documentaries.